in Asian equities, joining us this morning. Manishi, great having you. Let me first start off with your outlook on both growth as well as inflation and what that does in terms of stability for the RBI with regard to policy. The tilt that you are seeing in terms of what could shape up with regard to macro policy over the next 6 months.
Absolutely. Thank you, Hirsch, and a broad welcome to your viewers. It's a pleasure to be here. Coming back to your question about growth, inflation, and the implication for broad macro policy. First, I think India of late, if you look at the last couple of years, has been marked by good macro, but kind of pedestrian micro. What I mean by that is that the indicators of macro stability, like inflation, like current account deficit, they're very much in control. Fiscal deficit may overshoot a bit this year because of the fiscal stimuli in the form of tax cuts and the GST cuts that have been affected, but it's not going to be something alarming. Right. So, as far as policy direction is concerned, let's first focus on monetary policy. I personally think that as a consequence of the highest ever, the real interest rates that we have today, RBI has a lot of room to cut rates, maybe at least about 25 to 50 basis points in the near term. It's difficult to recall, even for me, and I've spent about 30 years in this market, when we had such low inflation. It's largely due to food, and that's why core inflation is still significantly higher. But at the same time, CPI at 0.25% is almost unprecedented in India's history. So, I personally think RBI should cut rates at this point of time. And what we should really wait for is the percolation down to actual lending rates. We haven't seen a significant degree of percolation yet. We should also hope for some degree of earnings estimate revisions. And that's something, again, we haven't seen yet for India. Earnings estimates have been declining since past 15 months, since last September, approximately. And, they're still just about stabilized, and partly due to the base metals and, the oil companies, the oil marketing companies in particular. But we haven't seen any broad basing of a superior earnings estimate environment in India, like we have seen in North Asia. So, despite the fact that we've seen valuations come down, we're not yet seeing the enthusiasm on the part of FIIs. I think they would wait for earnings estimates to move up.
Okay, and Manishi, how likely is that to happen? Because you're obviously seeing very, very strong underlying growth coming through already. And this is even prior to the full impact of the GST changes, which are yet to take effect, which will likely take effect in Q3. How likely is it for earnings to actually surprise on the upside? Because we haven't seen material changes in terms of earnings estimates, at least from the analyst community yet.
Absolutely. And a very correct point. And you started with talking about very strong growth. I would point out that even though real GDP growth has been 7.8% in the previous quarter and 8.2% in the last quarter, nominal GDP growth is actually down in the dumps. It's, in the range of 8 to 9%. And remember that corporate revenue growth and corporate earnings growth are governed by nominal GDP growth. So until and unless we have some degree of inflation coming back, maybe at least somewhere around 2, 3, 4%, we're not going to go back to the earlier level of about 11 to 12% nominal GDP growth and, the similar commensurate degree of corporate revenue growth. So I think, the question really is, when would consumption sentiment recover? We anecdotally know that it did during the festival season. We had some similar feedback from the auto companies, from the consumer discretionary, consumer durables companies. We haven't yet seen signs of that being robust enough to translate into earnings estimates. we may have to wait for one quarter. By the time the December quarter results come out in maybe January, I would expect maybe the period between January to March where we would see a slightly more broad-based earnings estimate revival. The indicators are there. The work has been done in terms of both fiscal and monetary stimuli. Maybe a little more work needs to be done from the RBI. But the impact in terms of better earnings estimates is what we are waiting for.
Right. Manishi, just wondering that anecdotal evidence is coming for autos for sure, but do you think they're priced to perfection for now?
Well, good question. So I would say that one has to be, investors would have to be very selective in this universe, because auto is one sector that has possibly performed the best in course of last maybe 3 to 4 months. Um, we are positive on that universe. We like the consumer discretionary space in general. Um, we like the private personal vehicle space, and particularly the market leaders in each of the segments who have strong pricing power and therefore, the ability to pass on any input cost increases. But valuations are no doubt a concern. Investors would have to be a bit selective on that front. But I think, if we do have earnings estimates moving up at some stage, what is appearing expensive today might appear relatively cheap tomorrow.
Manishi, we've known your views that you're positive with regard to the financials, the banks, especially in India. But what are reasons why they've not re-rated significantly? Margins have surprised on the upside for sure at the end of Q2. We've seen better than expected growth already getting clocked in. And we're seeing asset quality being unaffected, especially in the large cap space. What's ailing them? Is it just valuations which are higher than their global peers, you reckon?
When we speak to investors, there are two concerns about the Indian financials universe that keep getting talked about. First, a potential deterioration in the asset quality. And this particularly pertains to retail lending, possibly even microfinance and small scale lending. And second, potential decline in net interest margins. Now, I would point out these two concerns actually affect two different segments of the banking universe. So, as far as net interest margins are concerned, I think that impacts the large cap frontline banks more. Whenever interest rates do come down, we do have a moderation in net interest margins, but I would not really attach too much of a significance to that. The concern about asset quality in microfinance and retail lending, that is, again, it's valid, but I think it impacts the smaller banks, NBFCs, the microfinance institutions a lot more. So here again, one needs to actually sift through the concerns and the positives. On balance, I would possibly remain much more positive on the frontline large cap banks than the rest of the universe, though NBFCs might benefit as a consequence of rates coming down because they, somewhat paradoxically, are their margins are possibly more attuned. They tend to benefit when the rates come down because their liabilities reprice a lot faster.
Interesting. Manishi, what's the call when it comes to large caps versus SMIDs? Because of late, SMIDs have been underperforming while the Nifty managed to eke out their all-time high. But do you think in the year ahead, in the calendar year that is, things would change at all? And can we really see a broader participation from mid and small caps?
I personally think a section of these mid and small caps do look interesting. We know that as far as earnings growth and earnings growth forecasts are concerned, the small and mid caps fare better than the large caps. We have possibly early teens kind of growth forecast, earnings growth forecast for the large cap flag indices, but for mid caps, it's significantly higher. I think it's slightly lower for the small cap index. There's one interesting study that we did recently. We looked at, okay, the Nifty and Sensex, they're at an all-time high. But there are stocks and possibly close to about 90 stocks in India which are close to 52-week lows. Many of these are actually in that small and mid cap space. So we, of course, looked at only those stocks which are $500 million or more in terms of market cap. And even then, even in that restricted universe, we figured out there are at least about 90 to 95 such stocks. And many of them have very strong earnings growth forecasts going forward. A majority of them have very healthy balance sheets. Their net debt to equity ratio is less than zero point 0.3 to zero point 0.4, 30 to 40%. In some cases, even negative, which means they're net cash companies. So if one does, those quantitative, applies those quantitative screening tools, it is easy, relatively easy to come up with a decent universe of small and mid caps, which should do well going forward.
Right, Manishi, great to have you on the show. Thanks for taking the time out and speaking with us today.
Thank you very much.